Most working professionals believe that financial stability is built through income and spending discipline. Earn a reasonable salary, manage your expenses carefully, and wealth will gradually accumulate over time. That belief is logical, and for millions of salaried professionals across the United States and Europe, it is also quietly incorrect. The structural issue is not your income level, and it is not your spending behavior. It is the gap between generating income and converting that income into appreciating assets. That gap is where most professional wealth quietly disappears, and it operates through mechanisms that responsible financial behavior does not address. The first mechanism is what economists call the velocity of capital. In a modern financial system, money that moves through consumption cycles does not compound. When a professional earns a salary, pays fixed obligations, covers living expenses, and deposits a remainder into a savings account, that pattern feels disciplined. However, the underlying structure of that pattern places nearly all financial activity inside the consumption economy, where money exchanges hands but does not accumulate ownership. A mortgage creates equity slowly, but consumer debt, insurance premiums, subscription costs, and a low-yield savings account collectively absorb capital that could otherwise be acquiring productive assets. The structural result is that a high-income professional may produce significant cash flow over a decade, while ending that decade with a net worth that does not reflect it. The second mechanism is inflation asymmetry. Most professionals understand inflation as a general rise in prices. What is less often examined is how inflation affects different asset classes at different rates simultaneously. Since the early 2000s, the cost of housing, equities, and private investment assets has inflated significantly faster than wage growth in most developed economies. This creates a compounding access problem. The longer a professional remains primarily in a cash and consumption structure, the more the entry price of appreciating assets rises relative to their purchasing power. Saving money while asset prices inflate faster than savings yield is structurally a losing position. The professional feels responsible because the balance grows. The balance, however, is not growing relative to the asset base it would need to acquire. The third mechanism is fiscal drag, which is specifically consequential for salaried employees. Wages in most developed tax systems are subject to the highest marginal tax treatment available. Capital gains, dividend income, and carried interest structures are taxed at significantly lower effective rates in both the United States and across most of the European Union. A salaried professional earning $200,000 and a passive investor earning the same amount through qualified dividends do not occupy the same financial structure. They occupy different systems with different compounding trajectories. This is not a matter of tax avoidance. It is a structural reality of how modern tax policy differentiates between types of income, and most salaried professionals operate entirely on the high-friction side of that line. Understanding these three mechanisms points toward a specific strategic shift. The analytical priority for a salaried professional is not to increase income before repositioning financial structure. It is to systematically move a portion of capital out of consumption and cash positioning and into ownership of appreciating assets, even at modest initial scale. The common mistake professionals make here is waiting for a surplus large enough to feel meaningful before acting. That threshold rarely arrives because lifestyle costs tend to expand with income. The structural shift is not about the size of the allocation. It is about changing which system the capital operates inside. The second strategic priority is engaging the tax system at a structural level, not just a compliance level. This means understanding the full range of tax-advantaged vehicles available in your jurisdiction, including retirement accounts, capital gains treatment, real asset structures, and business income pathways, and building financial decisions around tax efficiency as a primary variable, not an afterthought. Financially sophisticated individuals do not primarily manage their finances. They manage their financial structure. They think less about how much they are earning and more about where that capital is positioned, how it is taxed, and what it is acquiring ownership of over time. The difference between a professional who builds wealth and one who does not is rarely discipline or income level. It is most often structural awareness, specifically whether their capital is working inside a system designed to accumulate ownership or inside one designed to absorb it. If this changed how you evaluate your financial structure, consider subscribing to Unfiltered Finance.